Welcome to Wheelixon, where history isn't just remembered, it's used to understand how money, power, and decisions quietly shape your life. For decades, inflation was treated as an enemy. Central banks feared it, politicians denied it, economic textbooks warned against it. Rising prices were framed as a sign of failure, proof that something had gone wrong inside the system. And for a long time, that was true. But applied financial history reveals a turning point most people never noticed. There was a moment when inflation stopped being something governments tried to defeat and became something they learned to manage, tolerate, and eventually rely on. Not loudly, not officially, quietly. This wasn't a single decision made in a single year. It was a gradual shift in behavior, one policy choice after another, until inflation was no longer treated as a crisis, but as a tool. To understand this shift, you have to understand the problem governments were facing. Not inflation, debt. After World War II, the United States emerged with unmatched economic power and unprecedented obligations, war bonds, veterans' benefits, infrastructure expansion, Cold War military spending. Debt levels that would have been politically impossible in peacetime were now normalized under the banner of national survival. At first, growth solved the problem. The economy expanded fast enough that debt shrank relative to income. Productivity surged. Demographics were favorable. Inflation existed, but it was modest, manageable. Then the system changed. Growth slowed, costs rose, promises multiplied. By the late 1960s, the U.S. government faced a structural dilemma: cut spending and risk political backlash, raise taxes and slow the economy, default and destroy credibility. There was one option left that didn't require a vote: let prices rise. Inflation does something few people are taught to notice. It doesn't erase debt outright. It reduces its real value. A dollar owed in the future becomes cheaper to repay when that dollar buys less. For governments, this matters enormously. Debt stays legally intact. Bondholders are still paid. No default is declared. But the burden quietly shifts from the issuer to the saver. This was the moment inflation began to change roles, not publicly, but functionally. The 1970s were the first warning. Oil shocks, stagflation, rapid price increases. Officially, inflation was blamed on supply disruptions and geopolitical instability. Unofficially, policymakers learned something crucial. Inflation relieved pressure. It softened debt burdens. It boosted nominal tax revenues. It allowed governments to meet obligations without openly admitting fiscal strain. Yes, inflation caused pain, but the system survived. That lesson was not forgotten. Fast forward to the early 2000s. Debt levels were rising again. Not just government debt, but household and corporate debt. Instead of tightening aggressively, central banks embraced a new philosophy: inflation targets, 2%, stable, predictable. On the surface, this looked like discipline. In reality, it institutionalized inflation, not as a failure, but as a feature. A small, controlled erosion of purchasing power became acceptable, expected, even necessary. This was the quiet normalization. Then came 2008. The financial system nearly collapsed. Governments and central banks intervened on a scale never seen before. Interest rates were cut to zero. Liquidity flooded markets. Balance sheets exploded. This should have caused inflation immediately. It didn't. And that delayed the reckoning, because what policymakers learned next was even more dangerous. They learned they could create money and delay inflation long enough to manage the political consequences. That changed everything. By the time the pandemic arrived, the framework was already in place. Trillions were created. Deficits exploded. Debt surged past historic thresholds. But inflation wasn't feared. It was postponed. And when it finally arrived, the language changed. Temporary, transitory, supply-driven. Notice what wasn't said. No one argued inflation had to be eliminated at all costs. The question shifted from how do we stop it to how much can we tolerate. That shift matters, because it signals intent. Applied financial history shows that when institutions stop framing a problem as unacceptable, they stop trying to eliminate it. They manage it instead. Inflation crossed that line, not because policymakers are reckless, but because inflation solves problems nothing else can. It reduces debt quietly. It funds governments invisibly. It avoids political confrontation. And once a system learns that lesson, it rarely unlearns it. This doesn't mean inflation is orchestrated maliciously. It means incentives changed. And systems always follow incentives. When the cost of stopping inflation becomes higher than the cost of living with it, the choice is made. Silently. Before we continue, understand this. This video is not about panic. It's not about predictions. It is about recognizing a behavioral shift. The moment inflation stopped being an emergency and became a strategy. When inflation becomes useful, the system changes its behavior, not overnight, not publicly, but structurally. Once policymakers accept inflation as a tolerable outcome, they stop designing systems to prevent it and start designing systems to absorb it. This is where the real consequences begin, because inflation never spreads evenly. The first group affected is savers. Cash loses value quietly. Fixed incomes fall behind. Purchasing power erodes without a headline. There is no announcement that your savings are worth less today than yesterday. It just happens. And because it happens slowly, most people adapt instead of resist. They change spending habits. They delay goals. They take on more risk, which leads to the second effect. Inflation pushes people into assets, not because assets are always safe, but because cash is guaranteed to lose. Housing, stocks, commodities. Prices rise not only because of demand, but because people are escaping depreciation. This creates the illusion of wealth. Portfolios grow, home values increase, markets look strong. But the system hasn't created value. It has redirected pressure. This is why inflationary periods often coincide with asset bubbles, not because speculation suddenly increases, but because risk avoidance disappears. Holding cash feels irresponsible. That's a dangerous shift, because when everyone is pushed into the same direction, fragility builds underneath. The third group affected is labor. Wages rarely rise at the same speed as prices. Negotiations lag, contracts are fixed, adjustments take time. In the gap between inflation and wage growth, living standards fall. But this decline is rarely described as loss. It's framed as cost pressures or temporary imbalance. Language matters, because when decline is reframed as inconvenience, it becomes politically survivable. Now comes the most important consequence. Inflation changes accountability. When prices rise, due to policy choices, responsibility becomes diffuse. No single decision caused it. No single actor owns it. Governments point to markets. Markets point to supply chains. Central banks point to global conditions. Everyone is technically correct, which means no one is responsible. That's the real power of inflation as a strategy. Historically, systems collapse when accountability becomes unavoidable. Defaults force admissions. Currency pegs break publicly. Institutions fail visibly. Inflation avoids that. It distributes pain widely enough that resistance fragments. No single group feels hit hard enough to revolt, but everyone feels just enough pressure to adapt. That's stability through dilution. Applied financial history shows this pattern repeatedly. Post-war Britain inflated away debt rather than default. Latin American governments relied on chronic inflation to manage obligations. Modern developed economies normalized price erosion instead of confronting fiscal limits. Different eras, same behavior. The danger is not inflation itself. The danger is what inflation enables systems to postpone. Structural reform, spending discipline, hard political choices. Inflation buys time, but time is not neutral. While inflation reduces debt burdens, it also reshapes society. Asset owners pull ahead, renters fall behind. Speculation replaces production. Eventually, the economy stops reflecting real output and starts reflecting financial positioning. That's when instability returns, not through prices, but through trust. At that stage, systems face a new dilemma: raise rates aggressively and risk collapse. Allow inflation to persist and risk legitimacy. This is the phase we're entering now, not a sudden crisis, a narrowing corridor. History shows that systems rarely reverse this process smoothly. They either tighten too late or inflate too long. Both outcomes lead to correction, just through different channels. This is why inflation should never be analyzed in isolation. It is not a standalone problem. It is a signal that the system chose postponement over resolution. That choice may be rational, it may be necessary, but it is never free. Understanding this changes how you interpret headlines. When inflation is described as cooling, ask compared to what? When rates are described as restrictive, ask for whom? When stability is celebrated, ask what is being delayed. History doesn't repeat exactly, but it preserves incentives, and incentives explain behavior better than narratives ever will. This is the final lesson. Inflation isn't proof that systems are broken. It's proof that systems are functioning exactly as designed. To survive, the cost is paid later by savers, by wage earners, by anyone who believes prices reflect reality rather than policy. If you want to understand money, power, and history beyond headlines, subscribe to Wheelixon. Here, we don't predict markets. We study decisions and the patterns they leave behind.